Are you looking for a high dividend-paying stock that owns iconic properties and operates in a niche monopoly-like market? Today we're diving into VICI Properties, ticker VICI, a unique real estate investment trust that might deserve a spot in your portfolio. We'll break down what the company does, analyze its financials, look at future risks and opportunities, and estimate an intrinsic value. Let's get started. Overview. VICI Properties is a triple net lease REIT specializing in experiential real estate, including casinos, hotels, entertainment venues, and golf courses. In a triple net lease or NNN lease, the tenant is responsible for property taxes, insurance, and maintenance costs, allowing VICI to earn predictable, low-risk rental income. Formed in 2017 as a spin-off from Caesars Entertainment's bankruptcy, VICI now owns some of the most iconic properties on Las Vegas Strip, including Caesars Palace, the Venetian Resort, MGM Grand, and Mandalay Bay. Their business model is simple and powerful. They own real estate and lease it out on long-term contracts, often plus 20 years with built-in rent escalators. This provides predictable cash flows, which is ideal for dividend-focused investors. Financials. Let's take a look how VICI Properties is performing financially. VICI's funds from operations per share is $2.5, and it currently trades around PFFO ratio of around 12.6. The company pays a quarterly dividend of approximately $1.7 per year, which equates to a dividend yield about 5.5%. The payout ratio sits at roughly 75% of AFFO, which is generally considered suitable for a REIT. While the short float is somewhat elevated, it's nothing alarming yet. In terms of performance, VICI has delivered a total return of around 16% over the past year and an impressive 90% over the past 5 years. This includes reinvested dividends. Revenue and revenue per share have consistently grown since the company went public. FFO itself continues to increase steadily, but FFO per share has shown signs of stagnation, remaining relatively flat in the recent periods. Meanwhile, the dividend has continued to rise, which could become a concern if the earnings growth doesn't catch up. That said, VICI maintains full rent collection and is actively investing in new properties, which bodes well for the future growth. Its debt levels remain reasonable for a REIT and don't pose an immediate threat. In summary, VICI appears to be a stable income-generating REIT with solid fundamentals and growth potential, though the lack of recent growth in FFO per share is something to keep an eye on. Though this shouldn't become an issue if the revenue per share keeps increasing. Future. Now let's look at the future with two segments: opportunities and risks. Let's start with the opportunities. If inflation keeps rising, VICI has rent escalators, so most of the leases have built-in CPI-linked rent increases. For growth, VICI continues expanding, including recent international deals and possible diversification outside of gaming. Experiential megatrend. Travel and entertainment spending is growing, which supports their tenants. Now let's move to the risks. Tenant concentration. A large percentage of rent comes from few tenants like Caesars and MGM. If they struggle, so does VICI. Rising interest rates makes financing new deals more expensive. Economic slowdown. A recession probably wouldn't hit VICI directly, but a recession could impact tenant revenues, although VICI's triple net structure offers some protection. But in case of a bankruptcy, the leases don't mean anything. Also, current political volatility affects travel as well. But so far, management has navigated these challenges well, and the long-term leases help to reduce short-term volatility. Intrinsic value. Let's try to estimate VICI's intrinsic value. VICI's forward AFFO is expected to be around $2.33 per share. Analysts are projecting about 3% annual growth, but I believe VICI has the potential to grow faster than that. Still, to stay conservative, I'll assume 3% growth for the next 5 years, followed by 2.5% growth for the following 5 years. Historically, VICI's price to FFO ratio has ranged from around 12 to 18. Given that the company's high rent collection rate and a near monopoly position in the Las Vegas Strip and strong management, I believe a higher multiple is justified. Personally, I think it could trade closer to 20, but to stay conservative, I'll use a PFFO of 15 as a long-term average. And as always, I aim for at least 12% annual returns on my investments. Using these assumptions, I estimate VICI's intrinsic value to be around $30 per share. Here's a quick look of different price targets and their expected returns. At today's prices, VICI seems a bit overvalued, at least based on this model. But I still think VICI is a buy. Why? Because I see an asymmetric risk-reward setup. The downside risk is relatively low, unless Vegas sees a significant long-term decline. The base case is slow, steady FFO growth, but there is a real possibility of VICI outperforming expectations, especially if management continues to execute well. A 5% growth surprise instead of 3 could make a big difference over time. You are also getting a solid dividend in the meantime. And if you believe in the CEO and the long-term Vegas story, there could be a meaningful upside. As always, do your own research. This is not financial advice. Conclusion. VICI is a unique REIT with dependable cash flow, iconic properties, and an attractive dividend yield. While it has some risks, particularly tenant concentration, its long-term leases and growth strategy makes it a solid contender for income-focused investors. I do own the stock and I feel like it's a buy, but I won't be buying more. I'll be watching for continued AFFO growth and smart acquisitions before buying more. Well, what do you think about VICI Properties? Let me know in the comments and don't forget to like and subscribe if you found this helpful. Thanks for watching. And if you want to invest in other REITs or just looking for some high dividend companies, check out my video on 2 REITs you might want to buy. And as always, do not lose money and safe travels. Bye bye.